your hands or type or unmute yourself to explain and to be able to explain more about your doubts or any problem that you have. So this is an overview of the model topics, and this is going to be in this 4 topic. I'm going to try to give it to you in 2 hours in only one session, but this is a lot of information. So if we don't finish today, we are going to set another session in order to finish all the topics and all the detailed, all the content in this module. So after 1 hour, we are going to have a 10 minutes of break. And basically, these are the 4 topics that we are going to discuss, the time that each topic takes, and obviously the date. In the topic number 1, we are going to discuss and see what is a financial record keeping system and what these systems are important, why it's very important to have this kind of system, because they provided a lot of benefits. We are going to check that benefits. And additionally, we are going to explain the concept of liquidity and solvency, and we are going to be able to notice the difference and the importance of these 2 concepts, liquidity and solvency in a business. And then we are going to be more we are going to discuss topics more related to the pure accounting in terms of accounting equation, and the basis in the double entry method of bookkeeping. So I don't know if you have heard the concept of financial recording keeping, but I put 2 or 3 concepts in order to understand. Probably is kind of it's a lot of repetition of the same thing, but is in order to let you know that basically is the same thing but with different words, and additionally each concept brings more information and more ideas. So financial record keeping is simply keep records. Keep is like tracking all your financial transaction in your business or in a company business, in a firm business, is how the company maintains not only physical documents, but also how the company is tracking and how the company is registering that transaction in a specific system or in a specific platform. That system could be as simple as for example, a book note, or more complicated or more advanced systems like, for example, a specific software in a computer, or even the companies could develop some policies and procedures in order to maintain that records. So the first definition is implies tracking all movements of your money, but obviously is important tracking the money, but also it's important to tracking that other activities that don't imply money. For example, imagine that you are created a new business, so you need to sign off some documents in order to prove that your business or your company is created. So it doesn't imply money probably directly, but is a activity that need to be tracked. So the first definition implies money, but it's not only tracking money. So in the first definition, we can see that keeping records of all the financial transaction is important because it helps to track all the movement in your money and directly in your bank account. But it doesn't imply only money. In the second concept, we can see that that record keeping can provide important financial information of your business. For example, how much money the business or the company has in the bank account, if you have inventory, if you have, for example, fixed assets, like, for example, computers or cars, or maybe, I don't know, a land or a building. So the third concept that I put here is the activity of organizing and storing all the documents, files, invoices related to a company or any organization activities. So is storing and organizing is not only keeping, because we need to keep the documents or we need to record the transaction, is also give a proper structure, is organizing, is put, for example, invoices with invoices, documents, like, for example, invoices related to expenses with all the expenses together. And maybe we can subdivide the expenses, like, for example, the normal expenses like the rent, the electricity, the salaries of the employees, and maybe we can organize these expenses in another subsection that could be these expenses that are not very necessary, but we have in the company. Like, for example, imagine if a company it is investing in advertising. So probably this expense is not necessary, but the company has this expense. So is the way at the end, financial recording keeping is not only keeping, is not only have the documents, is also organizing the documents and giving a logical structure. So, but why? What are the benefits of having this financial record keeping? One of the most important is regularly monitor the overall growth of your business. So if we have this structure and this financial record keeping, we can see if in a certain period of time, our company is growing in terms probably of income, in terms of employees, in terms of areas. So it helps to monitor this growth. Another thing that is another benefit is that it helps us to create a strategy in terms of business. For example, if you have a company that is I don't know, is a company based on giving goods or products, we can see what is the cost of each product that the company is creating. Or probably is a company that is not based on products, is based on services. We can see if the service is important or is not important according to the necessities of the market. I can think, for example, in Netflix or in Amazon. No, the trend now is that the public is the people is buying through platforms, through internet, through technology. So if we have all the documents and all the business and all the transaction, all the financial transaction of a company recorded, we can see that trends. Like for example, Amazon could see, okay, the trend now with the COVID situation is that a lot of people are buying products to clean their houses, like for example, sanitizer. So another thing that we can, I don't know, maybe let's think in a company that is selling products. For example, iPhone. Now that recently iPhone has launched the new iPhone. So if Apple is tracking all that transaction, Apple is noticing if the new iPhone is profitable or not profitable, if the public is accepting that new product. So this is another benefit of keep all the documents and to record all the transaction of the company. Another thing is identify income sources and track deductible expenses. This is so important because overall, because of the expenses, because sometimes or most of the times, if a company is investing or is buying some things, they could be expenses that could be useful in terms of taxes. For example, one thing that could be deductible could be the salary. Part of the salary of the employees that the company is paying could be tax benefits. So we need to know exactly what is the amount and what are the concepts that the company is paying in terms of salary in order to let the company know the benefits of that expense that at the end could be an expense, but if we maintain this tracking, we can see that this expense could be a benefit in the future. Another important thing is faster decision. When we know what are the movements and what are the activities and operation of the company, we can make a better decision and faster decision because we know the whole picture of the company. Another thing is comply or allows to complete all the regulatory frameworks in most of the countries, and probably this is a mandatory thing that the government or the jurisdiction, depending on the country, ask for this financial record keeping is in order to prove all the operation of the company, that all the operation makes sense. Because imagine if we have a company and we have that is let's think again in iPhone. If we have that company and if we have expenses related to the core or the business of Apple, it makes sense. But if we have Apple and we have expenses related to another industry, this doesn't make sense. So for that reason, the authorities and the countries and the government is very interested to give a regulation in order to guarantee that all the companies are recording all the activities and all the movement to prove if the operation makes sense with the business of the company, and also to avoid, for example, fraud or narco traffic or money laundering. So obviously financial record keeping is to comply with the regulation as well. And the last, but is not the only benefits, this list is some of the benefits, is protect the company or protect ourselves in terms of any situation, any issues that we cannot get control. Imagine if you are suffering, I don't know, an earthquake. And if you have a correct organization of your documents, you can take the documents that are very important for the company, or in this case, think about yourself in the personal life. If you have all your important documents organized in a specific section, in a specific space in your house, if, I don't know, maybe a tsunami or maybe an earthquake or any natural issue, you can take those documents and keep it with you very easily. So this is another benefit of maintain all the records physically and not physically organized and recording. And also, these are more, I'm going to discuss 5 points deeply about the benefits and why do we need to have a financial document management. So now if we see, is not only maintain financial record keeping, is this has, when that structure is transformed, when the financial record keeping is transformed in a whole structure that contains not only a system, but policies, procedures, practice that is linked with the regulation of the country in which the company is setting in. When we have all that elements, now we don't have only a financial record keeping, we have now a financial document management. So because we are organizing everything that implies financial record keeping. So it's important to have this whole structure, because we can be a watchdog in the organizational activities. For example, we can if we have that record and if we have all these activities in our mind very clearly, we can create financial statements, or if we receive, for example, the visit of an auditor, external or internal auditor, we can give the evidence of all the activities that we are doing. Even we can create sales and purchase reports, and we can see if the business is growing in a positive rate, because sometimes we can see that a company is growing, but it doesn't mean that it's growing according to the goals or according to the strategy or the wishes that the owners or the company has. So basically we can see if the growing is positive or is not as we were expecting. And also maintain this management. It's because when we are, for example, in an audit, we can give the documents to the auditor in order to let the auditors know that the documents are authentic and they can verify every transaction and every recording. No, if the invoice says that we get 500 pounds, the system, for example, if the company has a automatic system, needs to present the same amount that we have in the invoice physically, and the record and the transaction that we are looking at the system of the company. Another benefit of the whole management in terms of financial record keeping is prepare authentic financial statements. Why? Because if we maintain, if we can see the same amount, for example, of the invoice and the same amount in the system, we can be very sure that the financial statement that we prepare or the accounting area is preparing is going to show the reality of the company. So this is another benefit of the management in this topic. Another here we have some examples. For example, records like income and expenditure statement show the overall profit of all expenses in your organization. So the most important financial statements are based on this income and this expenditure that are in the system. So if we have a very good management in the record keeping, we will have better financial statements, better reports, better documents in order to inform about the company. So the other benefit is proper identification of income sources. So for example, we have that companies that are that the main interest is to get profits, and other companies that probably are not very interested, or is not the main goal to have income or to be profitable. Think about, for example, a foundation that the main goal or the main purpose is not being profitable, is to help another people. No, depending on the foundation, probably could be a foundation in terms of helping the poor people, or some disabilities. So, but the thing that I want to explain with that is that think in both of the cases, firms that are very interested on doing money and things that are not interested of doing money. So if it's a company that is interested to do money, that company needs to know what are the most important source of income, which part of the business are more profitable. Probably is a company that is doing clothes, but maybe jackets is the most important cloth, but is not so profitable. So probably could be, I don't know, shoes. That shoes could be the less important product, but probably the shoes could be the product that is most famous and that is creating or shoes are creating more money in the company. Or think in the case of the company that are interested to get money, and think about the companies that are not interested to do money. They need to know, for example, if they receive a donation, which that money needs to be used in a specific purpose, like, I don't know, to support, I don't know, kids, or to support certain project or certain area, depending on the money on or depending on the purpose of the donation. So this is another benefit that we can have when we recall all the financial activities in the company, that we can identify the sources of income depending on the type of company or firm. The number 4 and the number 5 are very related each other. The number 4 is tracing your deductible expenses, that I explained a little bit about this point. But it's important because when we identify that expenses, and when we can see the benefits that we can have depending on the expenses, we can have multiple benefits. But also sometimes when we are doing these expenses deductible, we need to present proofs to the authority, because probably we could present our taxes and the authority thinks, okay, you present that taxes that are deductible, but show me the evidence why you are saying that this tax is deductible, and if you are following the rules, if you are following all the requirements that the authority is asking in terms to consider an expense deductible. So if we maintain a very organized and very clear recording, we can prove the authority that we are doing deductible the expenses according to the regulation. So it could avoid multiple problems when we receive that money back. Then the number 5 is very similar to the number 4, but the number 5 is more related to be more effective and more efficient. So if we have a very solid and efficient management infrastructure, for example, probably with a system, with some policies, we can manage all the taxes, not only in terms of receiving money, in terms of paying money, and feel with all the requirements of the authority in terms of taxes. The most famous recording keeping systems is this list: Stage 50, Bookkeeper, Turbo Cash. We have multiple systems. I feel that it's not important if the system is famous or is the most usable in the sector. It's more about when the company decides to choose any system to record all the transaction, is more about what are the necessities of the company, if the system can cover those necessities. So if we and even if we think about very small business, the record keeping, even we can be a notebook, or maybe an Excel in the computer. No, but in that case we would talking about small business, but medium or big companies, they require a more sophisticated system to record all the transaction, because those systems offer many benefits, maybe link departments, maybe every departments of the company in one only document. Maybe if one area is doing something, another area is doing another thing, at the end we can have the same documents. Or maybe they have the function of give us financial statements automatically. So I think that choosing a recording keeping system is more about the necessities of the company, or more about that than which is the most famous, or the system that offers more benefits, or more things, or more interfaces, or has many things. It's like a phone. Probably the most famous phone is an iPhone or is a Samsung Galaxy, but it doesn't mean that probably those phones would cover the necessity of a specific person. Maybe if it's a person that is very involved in technology, iPhone or Samsung could be a good phones, but probably if it's an old person that doesn't need a lot of technology, probably another brand would be much better. It's the same with the system that the company decides to maintain all the financial record keeping. So till now, I feel that the first topic is very clear, but if you have any doubt, please let me know. And even I feel that the first topic is very intuitive. So if you have any doubt, please type or let me know. So the second topic that we are going to review is liquidity. Liquidity is a concept based on raise cash. Is the ability of the company to rush cash in a certain period. So because it's not the same, probably the company has the ability, but probably the company could raise cash in 1 year, and maybe the necessity of the company is not having the liquidity in 1 year, is having the liquidity every 3 months. So liquidity implies getting cash, but also in a specific period of time, depending on the necessities of the company. There are two major elements or determinants of a company's liquidity position. The first of these two determinants is the ability to convert assets to cash, to pay. For example, if we have computers as fixed assets, it could be very easy if we need, imagine if the company needs liquidity, the company needs cash to pay someone. So do you think that is more that the liquidity is higher in the bank account or is higher in the fixed asset? In the bank account, we have cash. We have probably different currencies. So could be easy to go to the bank and bring the cash even when the cash is in multiple currencies, or could be easy if we take one fixed asset, like for example, a computer, the company sells that computer and then give cash. So it would be easier if we go to the bank and only get the cash. It could be much more complicated. If the company wants to get cash, if we take one computer, sell the computer, wait for the person that bought the computer to get cash. Now think that we have a computer and we have a system that was developed only for the company. So which of these two provide more liquidity to the company in case of a very, very complicated situation? If the company takes the same computer, sells the computer, and then waits for the person who bought the computer to bring the cash, or if what was the other example? Or the system, or if the company tried to look for another company that buys the system that the company owns in terms to get cash. So in these two cases, I think that selling the computer would be faster than selling a specific software that the company developed. So when we think about liquidity, we need to think which is the faster way to get cash. So liquidity is a very important concept in order to raise cash, but also in a specific period, depending on the necessity of the company. So we were talking about the two determinants. The first, I gave you the example of the bank account, selling a computer that the company owns, or selling a software, a system that the company has, which is the way to raise cash fastly. So this is the first element. Why? Because all these scenarios are based in short-term liquidity. And the second determinant is debt capacity. Debt capacity is if the company can ask for a loan, and if the company is generating cash in order to pay this loan. It's kind of similar, but at the same time it's different, because one is based on short-term liquidity and the other is based on the operation, in the capacity of the company to generate cash and then pay a loan or a debt. So let's move on. But how we can measure that capacities or that two determinants? How we can measure the ability to convert assets to cash to pay? We can have some of ways, like kind of formulas, like kind of ratios that we can check. For example, we have here in terms of short-term liquidity is calculated from the following measures and ratios. We can use that ratios to see if the company has the ability to convert assets to cash. For example, we have working capital, that the formula is current assets minus liabilities is the working capital. Why does it ratio is saying is that if we decrease the rights minus the obligation, we can see which is the money that the company owns, and probably based on that, the company could think if the company it can raise cash or not. Or we have another thing, another ratio, that is another formula. For example, quick assets multiplied by cash plus account receivable divided by current assets. This is another way to prove the capacity of the company to bring cash in a short term. So we have multiple ratios that all of them implied formulas. And this is a way to know if the company has the first determinant. The second determinant, remember that is the debt capacity. We have another ratios. Debt to total asset ratio, that basically the formula here is how much is the debt or how much is the loan divided by the total assets, the total of assets that the company owns. This is a formula to measure the debt capacity. Another is the debt to equity ratio, that we can divide here the debt or the amount of the loan divided by the equity. Remember that in the balance sheet we have these three sections: assets, liabilities, and equity. So we need to take the amount of the loan that we are thinking to ask or that we already have, divided by the equity, the one of the elements in the balance sheet. Another concept very important inside the company is solvency. Solvency and liquidity are very different, but they complement again each other. Solvency is the ability of a company to meet its long-term debts and financial obligations. Solvency can be an important measure of financial health. And why? Because in solvency, we are measured how strong is a company, if the company is healthy or not. It's like, for example, if we go to the doctor and if we have, and if the doctor is checking our heart, and if we can run, for example, during 15 minutes, it means that probably our health is good and we can run 15 minutes with any problem, and probably this is a sign that our body is in a good condition. As an example, I don't know. So same in terms of solvency. Solvency is how strong is the company. If the company has the capacity to react in terms of a catastrophe, or if the company has think about a bank. If the bank has the capacity in case of a failure or in case of very economic disaster, if the bank is strong enough to protect all the money, all the person that all the people that have invested their money into the bank. Solvency is the health and the strong and how if the company is strong enough. So the quickest way, same as in liquidity, solvency has another way of checking, like kind of the ratios that we saw in the previous slide. But basically, in this case, the quickest way to assess a company's solvency is checking the shareholders' equity. Again, remember assets, liability, and equity. And if we check the equity, the equity section on there, we can see the amount of money that the owners of the company invested at the beginning of the business. And additionally, in that section, we can see the earnings and the accumulated earnings of the company. So basically, we are in that section, in the equity section, we are checking the money that the company owns And if during the time that company is profitable or not. This is the solvency. Many companies have negative shareholders equity. So obviously this is a red flag because it represents that the company is a sign of insolvency. So automatically, if we see that equity is red, we have a very huge problem on that company. Solvency. The solvency ratio, there are another ratio in which we can calculate solvency, is net income plus depreciation and amortization divided by total liabilities. Another ratio that we can check, in which we can base we can take into consideration are debt to equity, debt to capital, debt to tangible net worth. We have total assets to equity. So we have many ratios that help to analyze if a company is solvent or is not solvent. So I'm not going to explain each of it because we have many slides to present. But if you have if you have any doubt or if you want to check one of them in detail, just let me know. Now we are going to see, let me check the time. We have 5 minutes more. We're going to see the balance sheet. The balance sheet, as I was telling you, is divided into sections. One side of the balance sheet represents all the assets, the other liabilities and equity. In the assets, we have all the rights, all the things that the company has. And liabilities, basically the same thing that represents liabilities is all the obligations. So, and equity is the money, the pure money, the money that the company has. And this is the basic formula. Assets is equal to liabilities plus shareholder equity. Very, very easy, very basic, but sometimes for some accountants, this is a very issue because sometimes assets are not equal to liabilities and shareholder equity. And this is a very, very huge problem. So this is the image of a balance sheet. We can see here assets. We can see here asset. We can see here liabilities, and here the equity. And if you see, both of the sides are equal. They need to be equal because for every assets we need to have a liability or an impact in equity. So I'm pretty sure that you have heard about the double entry accounting system. The double entry accounting system is basically this formula, this equation: assets equal to liabilities to shareholder equity. And the double entry accounting system is basically for each assets, you need to affect liabilities or shareholders equity, or every movement represent the movement in another part of the balance sheet. If you affect cash and cash equivalents, you need to affect another section in the balance sheet in order to maintain these totals equally. This is a double entry system. If you affect something in the balance sheet, you need to affect the other part. If you have, for example, if you affect, let's see, prepaid expense, you need to affect somewhere here, or in another case in the income statement. But let's see some examples. Here is the first example. If a business receives a loan, it will result an increase in the company bank's account, an asset, while it increase loans. So if we affect, imagine that we receive a loan that the bank says, okay, yes, company, I'm going to give you a loan. So it will increase the cash and cash equivalents because we are going to receive the money from the bank. But on the other side, we need to affect the loans long term. So if we come back to the balance sheet, we are affecting cash and cash equivalents here for the amount of the loan, and we are affecting this part here, the liabilities. Maybe we need to write a section called loans long term or something like that, and we are affecting the balance on this side. So obviously, if I increase here, I don't know, the amount of the loan, I'm going to increase that total. And if I increase, for example, here accounts payable, because in a certain moment we need to pay that loan, is an obligation. If I increase this part, I'm going to increase the total on this side. So basically, this is the double entry accounting system related to the accounting equation. Another example is, imagine that if a business buys raw materials and pay in cash, this is very important, it will result in an increase in the company's inventory and assets while reducing the capital or another asset. So if we are paying in cash, it will decrease the cash and it will increase the inventory because now we pay, we don't have that money, but we have raw material. And let's go back to the balance sheet. I'm increasing the inventory because now we have more raw material, but I'm decreasing cash because I paid for that material. So if I increase here, I'm going to decrease here. Or this is in the case if we if we bought in cash, but if we bought if we will say, okay, I'm not going to pay you now, I'm going to pay you in 3 months. So it would represent an accounts receivable. So in that case, we are going to increase my inventory and I'm going to increase my account payable. Why? Because I'm not paying right now. I'm going to pay in the future. So these are the two examples of the double entry and the equation, the accounting equation. So let's leave till here, 10 minutes of break, and then we come back to continue with the second part of the class. So let's take 10 minutes break and then we will back. Okay. So the second topic is focus on, obviously, terms of adjustments. And we are going to check in this section what are the adjustments and what they are important in the preparation of financial accounts and financial statements. And also we are going to check not the most important, but at least the most common adjustments. And why those adjustments are very crucial to the company, and how is the way to do that adjustments, to do those adjustments. So sorry, I'm going to put that here. The importance of end of year adjustments. We can have adjustments. Imagine an adjustment is only to repair or only to register someone that we haven't registered yet. So it could be at the end of the month, at the end of the year, before generating a report. But the most common moment to do adjustments is at the end of the year. Why? Because normally most of the companies are based their adjustments for a whole of the year. Let me check, because I feel that I have. Yes, I'm going to send Mohammed. I'm going to send this presentation to the school, and the school is going to send it to you as well. So yes, no worries. So in a more theoretical way, an accounting adjustment is a business transaction that has not yet been included in the accounting records of a business as of a specific date. That specific date could be at the end of the year, at the end of the month, or before delivering any kind of report or any kind of financial statement. Most of the transactions are recorded in day-to-day basis, but some of them probably needs to be recorded in a very specific period, not precisely day-to-day. For example, a supplier invoice, a customer billing, or the receipt of cash. If we think about a supplier invoice, we need to record this transaction probably till we have the physical invoice, because maybe it's a supplier that is providing a service, and based on the service is going to be the amount of the invoice. So we need to wait till the service is provided in order to record the amount of the invoice. It could be an example in which we can do an adjustment at the end of the month, or at the end of at the end when that service is provided, of that product is provided. So, or imagine that we are in the process of getting a loan from the bank. So we cannot record that loan because it's in the process of authorization of the bank. So probably we are almost sure that we are going to receive the loan, but we cannot register the loan because it's not in our bank account, or the bank hasn't said yes to the loan. So we need to record the loan that we ask, or that money, when we have that money in the bank account of the company. So these are kind of adjustments that we need to do at the end, not precisely the end of the year, but in the end of the period. Normally that transactions, because most of the companies have this software, the software that we discussed in the first topic, in the first section. That software maybe has the function to generate that adjustment. So, but we need to put, for example, the amount, and we need to add the date of the, for example, the invoice. Or some of these adjustments are automated, so we don't need to do anything. Probably we only need to do a certain we need to do certain things that in the system, and then the system is going to recognize that adjustment and the period in which the system has to generate that adjustment. I mean, the adjustments are not only manually, they could be automatically. In this case, transactions have not been recorded at the end of the accounting period. So for that reason, we need to have this whole vision of all the operation of the entity, to don't forget any activity that needs to be recorded in the system or in the day-to-day activities of the company. The adjustments basically are designed to bring the company's reported financial results into compliance, and also are recorded because we need to generate financial statements, and that financial statements are necessary depending on the framework. When I am saying framework, I'm talking about accounting principles, accounting rules, mandatory issues. So we have in the adjustments some concepts called reversing entries. So these basically are adjustments, but we call reversing entries because we need to set in the system at the beginning of the next period. Imagine that we are very sure that we need to do something in the next period. It's almost sure, it's 99.9% that we are going to generate that transaction or that operation. If we have a very high level of certainty that we are going to do that activity, we need to adjust our financial statement when we are very, very sure that we are going to have this activity. So when we are very sure about that, this is a reversing entry. I'm going to explain in a while why these are called reversing entries. And that reversing entries normally are called accurate revenue and expenses. Accurate revenue and expenses and accruals and provisions, these all kind of adjustments could be called reversing entries as well. And if we don't do that adjustments or that reversing entries, we cannot have a correct financial statements. Again, these reversing entries can be set automatically or manual. So another adjustment that we can do or reversing entries is revenue and cost of sales. These two concepts are together. Revenue, as everyone knows, is the total amount of money received by a company for goods or services that the company is selling during a specific period. So because we are selling a product or a service, the company has the cost of that product, of that service, and the gap between the cost and the revenue is the profit that the company is generating. Cost of sales is more related to companies that are producing products instead of services. Basically, we have only cost of sales in that manufacturing entities. We don't have cost of sales, for example, in a company that is selling products. The cost is called another cost that is not cost of sales, could be like maybe cost of the service or another kind of cost, but it's not cost of sales. This concept is only for manufacturing companies, companies that are selling products, physical products. So cost of sales is also known as a cost of revenue, or this is the acronym. Cost of sales is the track of how much is the cost of producing any kind of good. So, for example, if we have a manufacturing company, we need to include in the cost of sales in the cost of goods sold the direct labor. For example, if we have a factory and we have employees that are doing that product, we need to include the salary that the company is paying to those employees, because it's part of the cost of the product. And also, we need to consider in the cost of sales direct materials. For example, raw material could be natural resources, basically, or if we are doing, for example, I don't know, food, we need to consider, for example, ketchup, we need to consider in the cost of sale the cost of the tomatoes. And to register, this is a concept that we need to know when we are determining the cost of sales. Under the IFRS, I don't know if you know what is that acronym, is International Financial Reporting Standards and the US GAAP. I put US GAAP because, you know, or US GAAP or UK GAAPs or wherever financial gap that we have in the country. Those regulations require a method of valuation in terms of recognizing the cost of sales. One of these is first in, first out. The other is last in, first out. And the third one is a weighted average. So when we are thinking in manufacturing companies, we need to think about revenue, about cost of sales, and we need to think in valuation methods. What are the valuation methods? First in, first out, last in, first out, and weighted average. These are the ways in which we can determine the cost of sales, and having these valuation methods, we can determine the value of the end of the year adjustments. As the name is telling us, first in, first out, imagine that we have a space in which we are going to keep all of material, all of the inventory of the company. Imagine that we have a company like, for example, Zara, that the main business of Zara is selling clothes, or I don't know, Adidas or Nike, or wherever other brand that is selling clothes. On that case, the most common method, the most common inventory method, evaluation method, would be first in, first out. Why? What does it mean? That the first product that enter in this space in which the company keeps all the inventory is the first product that the company is going to sell. Why I'm giving you the example of clothes? What would be the most effective inventory valuation method? Because imagine the trends during the year. Probably the clothes that you buy on summer is different than the clothes that you buy in spring or in winter. So first in, first out is you need to sell the first the products or the clothes in a spring. For example, imagine a very light t-shirt. You need to sell this first, because obviously if the time is passing and we reach the winter, the public or the people is not going to be, or the people are not going to be interested on a very light t-shirt when it's winter, when it's cold. So in that case, then the company needs to sell first that very light t-shirt. So for that reason, first in, first out is more common in that kind of industry. Now let's move on to the another valuation method, last in, first out. It means that the last product that enter in that space in we can storage all the products of the company is the last in, first out. Is that the product that entered at last is a product that we need to sell. This is more common in companies related to food, because obviously most of the food is spoiled in a very short period. And then we have the average cost. The average cost, as its name says, is we don't need to determine the price of the product at the beginning or at the end, or if it sell at the end or at the beginning. We need to determine a price for the whole material that we have, only one specific price. So for that, we need to use the method average cost. We are going to give the same price, the same cost to all the raw material. This is an example in which we can use these different evaluation methods. Imagine the first 3 units, the units cost is £5, $5, $5, wherever you want to produce. This is the cost of the first 3 units. However, due to the rising material prices, the last unit costs 10. So it means that the cost of the first 3 units is 5, and the cost of the last unit that we produce is 10. The subsequent period, the company sold the 3 units. So we have in our inventory 4 units, and 3 of them are sold. So how we can determine the cost of the product and then determine the adjustment or the entry? So if we are following the first method, first in, first out, it means that the cost will consist that the first 3 units, the cost will be 5. multiplied by 3, that were the units that we sold, the cost of the total material that we sold is 15. So we need to register an adjustment in the cost of that material, 15 pounds. So let's think in the second method. Last in, first out. So it means that if we sold 3 units, but the last cost was 10, so 1 unit multiplied by 10, because it was the last unit that entered in the inventory, plus 2 units multiplied by 5, because in order to complete the 3 units that we need 2 units in 5 pounds. So the total of the entry, or the total of the adjustment, will be 20. This is in the case of the second valuation method. In the third valuation method, is a little bit more complicated, but it's complicated in comparison with the two, or with the first two, but in general, it's not complicated at all. So in weighted average, we need to do the next operation. The 3 units multiplied by 5, because we have 3 units and the cost is 5. We need to add 1 unit that the cost is 10. So if we do this operation, we will get 25. So, and then we need to divide by 4, because at the end we have 4 units in total. So the cost of the material that we sold, the cost per unit is 6.25, and we need to update that cost when we produce another unit. So in this method, the cost is moving constantly. So if we have the cost of unit, we need to multiply by the 3 units that we sold, and this is 19.75. So if we can see, we have different costs depending on the valuation, depending on the method that we are using, is the amount of the adjustment that we need to do in the cost of sales. And also, depending on the amount of the cost of sale, we will have the profit, because if we sold if we got a revenue of 20 pounds, we need to decrease 15, 20, or 18. So the profit will be different depending on the method. But probably you will think, okay, I'm going to use this method because it means that is 15, the cost is the smallest, and it means that I'm going to have more profits. This is not the thing. The thing is that we are not using the correct method according to the necessities of the company. For that reason, it's very important to determine which is the method that better suits with the necessity of the company. So these are the adjustments in terms of revenue and cost of sales. So then we are going to check another adjustments. Another adjustments related to account for irrecoverable debts and provision for doubtful debts. So irrecoverable debts are this is like a provision that we need to do in our financial statements when we predict that maybe some of your clients, of some of our customers are not going to pay us. So because we have, the company has that risk. Probably the company could have very good clients, very good customers, but there is a risk in which that customer could have any problem, and there is a risk in which the company cannot receive the payment for that product or for that service that the company sold. So in order to measure that risk, we have this concept, recoverable debts, that basically is that we are recognizing the risk of a customer of don't have the money if a customer didn't pay us. And this is more like a fact, the recoverable debts, because we don't have any option. The customer, the client didn't pay us. And this is allowances for doubtful debts is very similar, but when we can reverse that risk, when this is almost a fact, and I would say that this is like, okay, the company is very conservative, and the company doesn't want to take any risk, and the company decided to have a provision, like in case of if something happened. So these are the entries, or in case of both of the cases. For example, in the case of irrecoverable debts, this is almost a fact. This is 90% or almost 100% that the client won't pay us. So in that case, it's irrecoverable. The client is not going to pay us, so it means that we are going to affect that concept, and we are going to decrease the accounts receivables, because we cannot count on this money anymore. So this is the way in which we can affect the in case of irrecoverable debts. If we go to the financial statement here, normally that section we have here, accounts receivable, and is our irrecoverable debt. We need to decrease here the amount of the amount of money that the client didn't pay us, and then we are going to affect this in retained earnings, that we need to have the earnings of the period, and we are going to affect here because it's almost a fact. The company doesn't count on this money. So, but what happened in case of allowances? Allowances, we have more chance. The company is more conservative because the company feels that probably the client is not going to pay, but it's not a fact. So the thing that we are going to do here is imagine that the allowance is here we need the amount needs to be 5,000. So the company determines that 5,000 is the amount of the allowance. So in this case, we are not going to affect any other thing, like here, accounts receivable, we are going to decrease here in 5,000, and we need to open another segment here with the name of allowance. So we are going to decrease here 5,000, and we need to add a new concept here called allowance, and we are going to increase that. Why? Because this is not 100% sure. It's only if something happened. So can you see the both difference? Here is 100 or almost 100% that the client won't pay us, and here is a prediction, but it's like maybe less than 50%. But the company wants to be sure that if something happened, the company is recognizing that risk. So I feel that we have, I'm going to give you another examples, and I hope we can finish in like 10 minutes. We are not going to finish that model in only these 2 sessions, but we can continue in the next in another session, maybe in a session of 1 hour, because it's a lot of information, and probably you need to check the presentation in order to see if you have doubts, because I'm very conscious that all these kind of concepts could be very easy and could be very basic, but the exercise and understanding the sense of every concept is kind of difficult, and you will need a little bit more time. So for that, I'm going to teach you maybe 15 minutes more, and then we can have another class to continue the presentation. Now we are going to see what happened with accruals and prepayments. If you receive an invoice or make a payment that covers several months, it means in a medium term, probably, and you record it a total of the sum in 1 month, this can affect your profit per month. So rather than record the whole amount that you pay or the whole amount that you receive for the next, I don't know, 5-7 months, instead of do that, we can have the option of the companies have the option to divide this amount in different months, depending on the months of in which the payment or the accrual is covering, in order to don't have a very huge impact in the financial statements. I'm going to explain in more detail in a little. This, if we recognize per month instead of recognizing everything in one whole month, in only 1 month, it will provide us a more realistic picture of the company and the profits or deficits of the business. So, but we need to be sure that we are covering the condition of divide that whole amount of money in different months or in different periods. It's not like we can decide because it's more convenient for the company. We need to know if the prepayment or if the accrual is ready or is accurate to divide it in different months. So this line is very important. Keep in mind, prepayments are the payments for that are not yet included, and accruals are the expenses incurred but not yet paid. This is so important. Prepayments are payments that we have done that the company have done. And accruals are expenses that are not incurred, that are incurred but are not being paid yet. Prepayments. Let's start with prepayments. Prepayment is when you pay an invoice or make a prepayment for more than one period in advance, but want to show this as a monthly expense or your profit or loss. For example, if you pay your rent in January and that payment covers the next 6 months, it means January to June, it is a prepayment because we could have that benefits instead of record all the prepayment. Imagine that the company paid the rent of the building, but the company has a lot of liquidity in January, and the company thought, okay, I'm going to pay the next 6 months of my rent because now I have the capacity to pay the next 6 months. So in this case, we're talking about a prepayment. In this case, we can divide the amount of money in different months. Doing that, we are not going to have a very huge impact in our financial statements. So we have here rental expense in January in the different months. Okay, so we have here 5 months. 5 months because the first month was applied into the current month. It means in January, but the next months are not going to be applied in January. They are going to be applied depending on the month. So we are going to present 1,200 in the next month, and in the next month 102,000. We are going to divide that expense in different months, even when we pay the 6,400 plus I don't know, this amount multiplied by the 6 months, we are going to recognize only 5 months as prepayment, because remember, 1 month is the current rent. So we are going to have a prepayment of 6,400 as a prepayment, but we are going to affect the financial statements per month. It doesn't mean that we are not recognizing the prepayment, because we are going to have a section called prepayments. That section is going to indicate that we did a prepayment, but we are not affecting the financial statement. That is different. We are reflecting the operation, but we are not affecting the income statement, the revenue or the expenses. We are not affecting that. This is a prepayment. But what happened with accruals? Accruals is kind of opposite of prepayments. When we don't have, in the case of prepayments, we were talking about a rent that the company pays in advance. But in case of the accrual, it could be an amount of money, a revenue that we haven't received, but we have a very high level of certainty that we are going to receive that revenue. So, for example, if we have a contract with a company, with a client, and that client says, okay, we have a contract that I'm going to pay you a certain amount of money in the next 3 months, we are recognizing the accrual. We are not affecting the income statement because this income is not real. It's only in the contract, but we are recognizing the value of that contract. This is an accrual. And obviously, if these 3 months pass, when these 3 months have passed, we can affect directly the income statements in the section of revenue. It's the same with prepayments. We are recognizing the prepayments, but we are not affecting the financial statement. In this case, the income statements. Same with prepayments. We are recognizing the prepayments in the balance sheet, but we are not affecting anything in the income statement. I don't know if it's clear till here, because I know is probably link these two concepts with the balance sheet and income is kind of difficult. But for that, I'm going to give this presentation and you can read slowly. And even if you have doubts, you can check online or you can send me an email. So this is an example of accrual that, let me check the time. Okay, we have three more minutes. So this is an example of the accruals. Imagine that you have an electricity expense and for example, if you are a company that is selling something related to electricity, so probably you can recognize part of that contract. Probably you have a contract in which the certain company is going to buy you the electricity. So you can recognize in cash if the company give by the month of in which you can recognize that income. But as an accrual, you need to wait till the another month passes in order to recognize this realized income, and you are going to affect the income statement only when these 3 or that period passed. I'm going to finish here because it's a lot of information, but in the next section, we are going to talk about the depreciation. What are the adjustments in terms of depreciation, and we are going to go to the topic number 3 and topic number 4 that are very, very fast topic. So we can leave till here because it's a lot of information, and we can have another session around 1 hour. So take care. I'm going to give this presentation to the school, and the school is going to share the presentation with you. So take care, read the presentation, take notes, look at another exercise probably online or probably with accounting books. And any doubts, please let me know. So have a good night and see you next session.